The market right now is in a massive, massive bubble. There's going to be a big difference between this crash and the ones that we've seen before it. After this one, the government and the Federal Reserve aren't going to be able to save us. So even a return to baseline valuations at this point represents one of the biggest corrections in financial history. And these aren't the only indicators screaming for a bubble. The list goes on and on and on. But like I said, by almost every measure you can think of, the stock market today is in the middle of an historic bubble, one that's ripe for a crash. Some of the brightest financial minds of our time, people I've mentioned before, people like Jeremy Grantham saying this is worse than 1929, and Michael Berry who's saying this is the greatest speculative bubble of all time by 2 orders of magnitude. In fact, an entire cacophony of billionaires and leading financial minds are all singing the same tune. And so it's becoming clearer and clearer by the day that it's only a matter of time before the bubble bursts. But here's the most important part. Once it does, which as I'm about to show you could be just a few weeks from now, there's going to be a big difference between this crash and the ones that we've seen before it. After this one, the government and the Federal Reserve aren't going to be able to save us. The stock market won't shoot back up like it did or the 2008 financial crisis. This time it will stay depressed, and that could last for years, decades even. But if you thought 2008 was bad, well, take a look at this. Here's where the margin debt stands today. This is the highest point in history, almost twice where it was before the 2008 financial crisis, when the market corrected almost 55%. That means there's almost $1 trillion of borrowed money floating around in the stock market as we speak, and that when the next crash comes, it will be one of the fastest and most violent corrections in history. And just to prove my point, let me show you one more chart. This is what's known as the Shiller PE ratio. It's a bubble indicator developed by Nobel Prize-winning economist Robert Shiller, and it essentially measures how expensive stocks are compared to their earnings. It's at one of the highest points since the Great Depression, which means the stocks are more overvalued than they were in 1929. So even a return to baseline valuations at this point represents one of the biggest corrections in financial history. And these aren't the only indicators screaming for a bubble. The list goes on and on and on. But like I said, by almost every measure you can think of, the stock market today is in the middle of an historic bubble, one that's ripe for a crash. The next crash could be orders of magnitude bigger than the tech bubble, which is incredible enough on its own. But here's the thing. It's not the only bubble indicator that is soaring off the charts right now. It shows us how much money people are borrowing to invest in the stock market. Just before the dot-com bubble burst, it shot up to almost $500 billion as more and more people borrowed money to buy stocks. And just before the 2008 financial crisis, it shot up again, and people leveraged up their accounts with CDOs and MBS and so on. Anyone who believes that at this point doesn't understand history and is about to get a painful lesson in economics. Here's why. You see, over the past few decades, in order to avoid any type of crisis in our economy or financial system, we've been using every spigot we can find to pump money and debt into the system. After the dot-com crash, Alan Greenspan lowered interest rates, forcing money into the economy and inflating what would become the housing bubble. Once the housing bubble began to collapse, Ben Bernanke, a man I've had personal conversations with, by the way, lowered interest rates even further and began something called quantitative easing, what most people consider the purest form of money printing. Now the U.S. debt has never been higher, and we've never had so much money in the economy at such low interest rates. And even though most people watching today know this is not a good thing, and that this can't go on forever, there's one key reason the Fed has been able to get away with this. One key reason why for decades now the Federal Reserve has been able to print money practically ad nauseum, bailing out the markets over and over again without incurring the wrath of the American voting base. The market right now is in a massive, massive bubble. Let me show you what I mean. Take a look at this chart. This is the market cap to GDP ratio. It gives you a gauge of how much money is invested in the stock market relative to the size of the economy. And it's Warren Buffett's favorite indicator for predicting a market crash. In fact, in 2000, at the peak of the dot-com bubble, when it hit the highest level in history, Warren Buffett said it was a very strong warning signal of the crash to come. And he was right. After it hit its peak, the dot-com bubble burst and sent NASDAQ plummeting more than 77%. And it didn't recover for nearly 15 years. Well, here's where that indicator stands today, almost 113% higher than where it was during the very height of the dot-com bubble. That means there is more easy money flowing into the U.S. stock market than at any other point in history. And once it goes away, it's going to be game over for the market.